the ups and downs in the financial markets can make anyone anxious. You might be wondering, especially in this economy, why you should invest in the stock market at all. Avoiding the stock market might seem like a good idea, but it could expose you to other risks. Think about this. Things like food and energy cost a lot more today than they did 10 years ago. The price of goods has historically increased by an average of 3% per year. If you put your money into a CD paying 2% annually and the price of goods increased by 3%, you wouldn't be able to buy the same amount of goods in a year. This is called purchasing power risk. Here's another example. Advancements in medicine and technology could help you live well into your 90s. If you retire at age 60, you'll need to stretch your savings to last over 30 years. It's possible that you might outlive your money. This is called longevity risk. In order to combat purchasing power and longevity risks, we recommend you use the stock market, not fear it. Overall, the stock market, as represented by the S&P 500 index, has outperformed both long and short-term bonds after inflation and taxes over the last 85 years. The fact of the matter is, many of us are very successful in our businesses, but we are very emotional when it comes to our own investments. The average return of the S&P 500 index over the last 20 years was around 9%. During that time, inflation averaged about 3%. But here's what's really interesting. During the last 20 years, the average equity investor significantly underperformed the market and made only about 4% per year. Studies suggest that emotions are what cause most investors to underperform. Because we often let emotions guide how we invest, we tend to look for the best money managers to help us beat the market. However, over the last 15 years, only 44% of active managers beat their benchmark. That's about 2 out of every 5 managers. Even if you were to invest with these managers, there is a chance that many of them would underperform in the future. We sometimes forget that past performance is not a foolproof indicator of future results. Have you ever looked at a mutual fund prospectus and wonder why it says that? Because it's true. Yet most investors keep looking at past performance to try and predict what will happen next because we have no better performance barometer. Trying to time the market is another example of emotional investing. If you invested $1,000 in the S&P 500 in January of 1970, that $1,000 would be worth about $50,000 today. If you missed the 5 best days in the market, you would have only about $30,000. That's a 35% drop in your return just for missing 5 days. If you missed the best 15 days, you would have only about $18,000. In other words, 15 days out of 10,000 days produced over 50% of the return of the market. When you time the market, you are essentially guessing when the best day may occur. We believe that time in the market, not timing the market, is the best way to create wealth over time. Once invested in the stock market, it is imperative to diversify your portfolio. One of the most important factors influencing the return of a portfolio is asset allocation. In fact, research suggests that 91.5% of a portfolio's return comes from asset allocation, and 8.5% of the return is determined by other factors. Asset allocation is very much like baking a cake. The individual ingredients are not something you would consider having as a meal, but when combined, the results can be delicious. Emotional investing and trying to time the market may adversely affect the return of your portfolio. In contrast, the Portfolio Advisory Services program takes the emotion out of investing with a disciplined approach. The program attempts to capture market returns by investing in low-cost and efficient investment vehicles.
The investment philosophy of Portfolio Advisory Services is based on several Nobel Prize-winning concepts, including the capital asset pricing model. William Sharpe developed the capital asset pricing model and identified 3 risks when investing. The first is picking the wrong company. The second risk is investing in the wrong sector. The third risk is the market itself. Sharpe's work suggested that if you diversify your portfolio, you'll be less affected by one company's or one sector's poor performance. This research evolved into the concept of efficient markets and the creation of index funds. This led to continued progress in the investment management industry and refinements to concepts like modern portfolio theory. At the core of portfolio advisory services is modern portfolio theory, a Nobel Prize winning theory developed by Harry Markowitz from the University of Chicago. Modern portfolio theory states that by mixing different asset classes that move in opposite directions, we can increase the return of a portfolio while lowering its volatility. Imagine a car with an 8-cylinder engine. Each cylinder represents a different asset class. At any point in time, half the cylinders are up and half are down. That means your car, or in this case your portfolio, is moving forward. Even though all the asset classes in your portfolio may not go up at the same time, we seek to provide you with a sustainable investment strategy that will allow your assets to grow over time. Eugene Fama of the University of Chicago and Kenneth French of Dartmouth took things a step further. They identified 3 additional influences that affect a portfolio's return. The research, called the 3-factor model, suggests that investors can generate returns by allocating funds to equities. It also proposes that small company stocks have higher expected returns than large company stocks, and value stocks have a higher expected return than growth stocks. Their research suggests that this phenomenon potentially occurred not only in the US, but all over the world. Essentially, this research proposed that if you diversify your portfolio across the market and tilt towards small and value companies, you could increase your expected return. We design your portfolio using all the information we just discussed. A mutual fund company called Dimensional Fund Advisors, or DFA, was built using academic research grounded in modern portfolio theory. DFA funds have low cost when compared to the industry average and do not charge upfront sales charges or 12b-1 fees. At the end of 2010, DFA had over $200 billion of assets under management. Our average client has 12 to 14 DFA funds in their portfolio. The holdings inside of these funds add up to over 10,000 stocks spread across 40 different countries. Portfolio Advisory Services also offers global portfolio asset allocations that allow more international exposure. We also try to minimize taxes by using DFA's tax-managed funds and managing several accounts as one portfolio. Portfolio Advisory Services invest in various asset classes to create your portfolio. Historically, we observed that each asset class, as represented by its corresponding index, performs differently each year in comparison to other asset classes. Notice there is no discernible pattern. In any given year, a horrible event may occur, like Hurricane Katrina or the financial crisis. Yet there are asset classes that still perform relatively well in those years. Many people own just 1 or 2 of these asset classes. In Portfolio Advisory Services, you will own mutual funds that hold thousands of stocks in over 40 different countries. This will give you a tremendous amount of diversification and the benefit of the kind of tilt the Fama and French model recommends. One of the most important components in all our portfolios is the bond allocation. The bond allocation is the low-risk portion of your investment. When we invest in bonds, we manage credit risk and term risk. This protects you from companies that default. Long-term bonds, though they seem like a smart investment, provide only a modest increase in return with almost double the volatility. Therefore, in Portfolio Advisory Services, we typically purchase bonds with shorter maturities. Mutual funds have internal expenses that can affect the return of your portfolio. The expense ratio includes management fees, distribution expenses, and trading costs. Trading costs are the expenses funds pay when they buy and sell stocks. The DFA funds used in the Portfolio Advisory Services program have fund expenses and trading costs that are below the industry average. Our disciplined approach for the Portfolio Advisory Services program includes rebalancing. Rebalancing allows us to follow the first rule of investing: buy low and sell high. Over the last 20 years, portfolios that did not practice rebalancing had a lower average annual return and a higher maximum 12-month loss than portfolios that were rebalanced consistently.
We want you to feel comfortable investing in portfolio advisory services, so we have built transparency and accountability into our investment platform. The role of Genworth Financial Advisors Corporation is to create and monitor your portfolio, direct investments, and prepare quarterly statements. We do not physically hold your money or act as custodian. Your money is held in an institutional account at Charles Schwab. This separates the investment relationship from the brokerage function. Portfolio Advisory Services is a fee-based program. This means you retain our services and pay us an advisory fee based on a percentage of your account. Our fees are always disclosed at the beginning of our relationship with you. The important link between you and Genworth is your financial advisor. Your advisor will make recommendations tailored to your needs and can help you avoid emotional investment decisions. Together, you will monitor your account and meet at least semi-annually to discuss your portfolio. If you are interested in learning more about portfolio advisory services, talk to your financial advisor. Together, you will review your risk tolerance and investment objectives. Once you establish your financial goals, your advisor will work closely with you to develop a sustainable investment strategy to meet your long-term objectives.